Who's the head of research at Asit Mehta Investment Intermediaries. Great to have you on the show, Sid. We are interacting after a very long time. Let me first ask you about what you feel about the texture of the market. We've seen extreme volatility in the run-up to elections. We've had an earnings season that really, didn't have any kind of fireworks, so to say. So here on, what could be a big disappointment? Would you say that number of 400 will be crucial as we await the June 4 verdict? And looking at the commentaries coming in from the managements, what are your thoughts on how earnings will fare from here on?
Good morning, Nandita. Thanks for having me on your show. See, I'm not a political expert, but I think this 400 mark or 320 mark, it's a good story to talk about. But I guess even if it's not 400 and if it's like 350, 320, market might show some initial knee-jerk reaction. But as long as market believes that this government is good for economy and market at large, then even the continuity would be good for markets. That's what people are perceiving. So if there is a disappointment on those 400 front mark, then the knee-jerk reaction would come into play. And as you rightly mentioned that before such key event, volatility would spike. And obviously, if you look at the India VIX, that has also shot up in recent weeks. So this is part and parcel of, the process. My personal take over here is that you may not see huge movement after the election, what people are believing. And it may be, life as usual. Irrespective of the fluctuation between, say, 320 and 400. Coming to what we should talk more about is earnings. And as you rightly mentioned, there has been no fireworks, but there has been no major disappointment as well. See, last 2 years, markets have run up significantly post-COVID. And we have seen that, and we all were worrying that will earnings catch up or not? Will earnings justify these higher levels? Well, justify may be too strong a word right now, but earnings are catching up with these higher levels of market. So if if I just run down through some of the sectors, banking has been pretty fine with most of the large names showing good growth in net interest income. Though, some of the banks have shown some pressure on NIMs because of higher cost of deposits. But then we are seeing, great growth momentum, which has kept this main sector of our market quite ticking. And there has been no significant disappointment. And you can see in stock prices, barring, few hiccups in names like Kotak Bank because of unrelated reasons. We have seen dip over there, but otherwise most of the banking names have done well. IT, yes, there has been, some issues related to the guidance part of it, but except TCS, but that sector is not very expensive. So you may not see, a continuation of dip over there. We are seeing, good traction taking place in auto names. There is mixed trend in FMCG. So overall, I believe earnings season has been supportive, and I'm not just talking about this earnings, but overall earnings since last 2-3 quarters has been supporting this upward journey which our markets are into. Also, if I have to, touch upon, Nandita, some important development in US markets, and it should be prudent to discuss today, is a slight dip in inflation, though it was expected that inflation would fall to 3.4%. But the retail sales numbers of US has been disappointing for last month. And that is the reason you have seen that there is a sharp dip in the yields and also dollar index, which again is equity positive, emerging market equity positive. And even Dow Jones has closed at an all-time high again. So I believe that we should not be too perturbed by these events which would come and go, and after 2-3 months, we won't be discussing about that, but we will be discussing more about what's happening in budget now.
All right, you touched upon quite a few sectors, but I want to focus in on the FMCG pack in particular. You could say that it has been an outlier in terms of management commentary, right? Till now, premiumization as a theme was working well for FMCG. Now, stocks have come back to life after, the street has assessed what the managements have guided in terms of rural demand picking up. After the recent underperformance, do you think this is one pocket to look at in terms of valuations as well? Does it offer valuation comfort now? And should one play the FMCG pack in terms of rural demand recovery, given the fact that IMD has also predicted an above normal monsoon for the year?
True that. So, historically, Nandita, what we have seen that HUL used to set the trend or tone for the earnings, how FMCG would perform. But contrary to that, this quarter, what we saw that HUL earnings were in line but disappointing, with decline in profitability, decline in revenue, and margins pressure also being there. So that is what was expected from most of the other names as well. But as I mentioned, it was contrary to the historical trend that other companies came out with decent set of numbers, and more importantly, as you mentioned, the management commentary about green shoots in rural economy, did give market a reason to cheer. Having said that, I believe these green shoots in rural economy are you need to watch. If you look at the historical trend of how rural economy picks up. It's not that just the 1 quarter or 1 month numbers coming from rural economy would ensure that there is a change in trend. I would probably wait for more monthly figures coming from the economy, probably more quarterly number, and then take up a large bet on or large contra bet on rural play. Again, on the valuation front, which was your prime question, yes, it's relatively cheap. And if we talk about the leader of the sector, Lalita, since 2016-17, HUL has not traded below 50p, and it is available now. And I always tell to my investors and our clients that either you get a valuation support or you get growth clarity. Both cannot go hand in hand. So today the growth clarity is not there, and that's the reason you are seeing that stock like HUL available at these valuations. I'm not saying that there cannot be a downside from current levels, but the valuation support now exists. And if you're a long-term investor, and I'm not talking about 1 year, but if you're thinking of investing from 2-3 years perspective, I think it's a good stock to have exposure in.
All right. Of course, but you'll still wait for another quarter to take a contra bet on this sector, so to say, right? Coming to the infrastructure and industrial space, of course, there's been a lot of impetus in on infrastructure development, right? But we have seen a lot of these industrial and defense and railway stocks. We've seen an explosive run in some of these stocks, and valuations appear to be out of whack, but we still have a lot of brokerages still initiating coverage at this juncture. So how should one really position themselves, after the, massive run up that we've already seen? Would there be an entry point in any of these pockets?
Nandita, stocks, be it, infra space or capital goods space, just a year back where people were not ready to buy them at, low teen P, are now chasing them with P as high as 30, 40, 50. And I would refrain from doing that. But if I have to play today infrastructure space, and also where, the sanity of valuation also remains, is cement space. And that is where, we are concentrating on. Today, cement space, Nandita, we are seeing that the game has been more of volume growth. And that's the reason you name the company and they are talking about capacity expansion. There are different markets in cement. Most of the growth is coming, or the percentage growth, if you see, is coming more from eastern markets. Southern markets are a bit tepid right now. Western and central is doing pretty fine. Yes, valuations are not cheap, but then names like Ultratech, Birla Corp from mid-cap space, Shree Cement, these stocks are outliers in terms of, despite industry not showing much of rise in realization, these companies have shown increment in realization. Also, the entire sector is moving towards green energy. And as you would know, that fuel and power is the main component of costing in this space. And that is where I believe margin would remain stable going forward. So it has become a volume game, and this industry, though at current capacity might, these stocks on current capacity might look slightly expensive, but as the commissioning of new capacities and the production starts from them over a period of say 26, 27, I believe still valuation comfort lies in cement space. And if you want to bet on infra and also want valuation support with a decent amount of clarity in revenue growth, I think cement is the safer bet.
All right, there's still value in the cement space. But last question really said, what about the auto pack? This sector had been among the best performing sectors in FY24. And even on a YTD basis, we've seen the auto index up in excess of 20%. You talk about two-wheelers, four-wheelers, some of them are perched at record levels, right? Although Tata Motors did see a hiccup, of course, due to the margin guidance disappointment for JLR. But would you say that all the good news is already in the price, both in terms of two-wheelers and four-wheelers?
Not really. And I think case by case we will have to approach here, Lalita. You mentioned that they have been best performer in FY24 and even Y2D. But there is a reason behind it that they were underperformers since last 2 years. If you look at Maruti, Eicher Motors, these stocks have been languishing when market was doing good. Tata Motors has been outlier. Even, other two-wheeler space had not done really well. And now as monthly numbers data suggested since last 1 year or so, these stocks have been doing well. Yes, there might be, margin pressure here and there. But then for me, the market leader in terms of, number of people tracking that stock and how it represents the pulse of our economy is Maruti. And if you remember, a year back and even 6 months back, we were mentioning on your space that how instead of EV, the company has been concentrating on CNG and all models of Maruti were getting CNGized, if I can, term that. And that has led to, volume growth. That has led to margin growth. And Maruti knows the pulse of Indian consumer. And that's what has driven that. And going forward, I believe that the sales from small cars, which has seen tepid growth, that would pick up, and Maruti may continue to perform from here. You touched upon Tata Motors. Tata Motors has been doing phenomenal, but then going forward, as my analyst says, that there are probabilities of growth tapering, especially in Indian markets, and there could be a downward take in margins. And that's what, the guidance by management over a period of next 1.5 years, that led to fall in stock. Otherwise, numbers were pretty decent. Overall, auto space could be approached on stock by stock basis. In two-wheeler space, I think Bajaj Auto, which has seen a decent traction, and my analysis says that the growth visibility is much higher in Bajaj Auto compared to Hero MotoCorp. So that is one stock which, your viewers can keep eye on.
All right. Well, that's a view on the auto pack, both the two-wheeler and four-wheeler space. Maruti, of course, one of the premium plays according to Sid, and of course, Bajaj Auto has a higher runway for growth. With that, Siddharth, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. It's always a pleasure chatting with you, and I look forward to having a longer conversation with you sometime soon.
Thank you so much.
Well.